So this is a candlestick, and a candlestick it is something that looks like this. The candlestick has two major parts. It has wicks and the body. Then the wicks, we have the upper wick and the lower wick. So as you can see, this is the upper wick, this is the body, and this is the lower wick. So let's do the wicks. So if the upper wick is longer than the lower wick, it means that buyers try to push the price up to that specific moment where the upper wick ends, but sellers entered the market with pressure, pushing price down and to where the price closed. That is for a bullish candlestick. And then for a bearish candlestick, if it has the lower wick longer than the upper wick, it means that sellers try to push the market price to this end where the wick ends, but buyers enter the market pushing price to where it closes. So it means that on a bearish candlestick like this one, the open price is here and the closing price is here, and on the bullish candlestick it is vice versa. The open price will be here and the closing price will be here, because you have said that bullish candlestick are candlesticks that are going upwards, and bearish candlestick are candlesticks that are falling or going downwards. So basically that's the anatomy of candlesticks. So there are different types of candlesticks and how they look, and different patterns. So we are going to do them and see how they affect the market in real time. Okay, so now let's do the important candlesticks pattern. The patterns that there are many patterns, but we'll do those ones that they appear more frequent in the market than the others. So we start with the first one. The first candlestick pattern is called the doji. The doji looks like this. This is a doji. It has the upper wick and the lower wick of the same size, which shows that there was indecision. It means that if price opened here, buyers push this market up to this level, but sellers also push the market up to this level. So which means the market has not decided whether it wants to buy or sell. So this pattern, this candlestick shows that the market is in decision. The market has not decided yet the direction to take. So when you see this pattern, just wait for the market to decide before you can make any decision of taking any trade in a certain direction. So this is called the doji. We also have the spinning top. So the spinning top looks like a doji, but the difference between them is that the body of a spinning top is slightly larger than the body of a doji, but the wicks are the same, but the body size is the one that causes the difference between them, and they both show indecisions. They show that the market has not decided to take a certain direction yet. So our next candlestick pattern is a hammer. A hammer has a long lower wick, but a small wick on the upper side, or no wick completely. That's a hammer, and it has a body. That's a hammer. A hammer shows that sellers tried to push the price lower, but buyers entered the market and pushed price high, rejecting the selling pressure that was being imposed by the sellers. This usually appears after a downtrend, and it shows that the market is going to reverse and start going up, because it shows that sellers and the selling momentum has been absorbed in the market. So when this appears, try to look for a reversal to the upwards or a buying opportunity. If the hammer appears inside a bullish move or an uptrend, it shows that the buying momentum is about to end, and it shows that sellers are starting to enter the market, and its name changes from that of a hammer to a hanging man. So when this appears in a downtrend or in an uptrend, just try to look for a trend shift. The next pattern is called an inverted hammer. This is the inverted hammer. It has a long upper wick and a body, and a small shorter wick or no wick completely. This shows that the uptrend is coming to an end as the buying momentum is exhausted and sellers are entering the market. So this appears in an uptrend, and when it appears, you start looking for selling chances because the uptrend is about to end. So this is a signal to look for sales. So when it happens, shift your mindset to start looking for sales instead of buyers. All that being said, those are the most important parts, that the most important candlesticks that you need to know. There are other many, but those are the most that are common and that have impact on the market. So we are going to do candlestick patterns. A candlestick pattern is made up of two or more candlesticks together. So we'll start with the morning star pattern. So this pattern signals a potential trend reversal. So it appears most of the time when a bearish trend is almost ending, or a downtrend is coming to an end. So if you are in a downtrend and you see this pattern forming like this, you start looking for a trend reversal. So you start looking for buys because you expect the market to start going up. So it is made up of these candlesticks. So this can either be blue or black, all can be bearish or bullish, it does not matter, as long as it is a doji or spinning top here. Like the wicks are almost the same. You see, it is an indecision candlestick. Then if this bullish candlestick is bigger than the bearish candlestick, that's a high probability trade. You see this candlestick, it starts here and ends here, but you see this one starts here and ends there, which means this one is bigger than this one. So it means that this is a high probability trade. If this bullish candlestick was to be smaller than this one, then that's a low probability trade. So you take it with small risk and very, very, very cautious, because it is not a high probability setup. So that is the morning star. Okay, so as you can see here, this market was moving, then moving. When it reached here, it started dropping. What happened after it reached here? It formed this. See these candlesticks and see this one and this one. This is a pattern we had done. This is a morning star. So after this morning star, what happened? The market reversed. You see, it was dropping. Now what has it done? It has reversed and started going where? Up. So how do you trail this? So after it closes here, after you see this pattern, you wait for this candlestick to close. When it closes, you enter your buys here, you put your stop loss down here, and then you target somewhere here as your TP1, and maybe 1:2 or something. Okay, so this is the morning star. Now let's look for another one. So our next pattern will be the evening star, and this pattern is the opposite of the morning star. We have said that the morning star appears at the end of a bearish move. Now this will appear at the end of a bullish move, which means that the bull power is being exhausted, and bears are starting to enter the market. So the market is going to change direction and start going downwards. So if this pattern appears in the market, you start looking for sales. This, I've told you that this spinning top or doji, it is not a must to be bullish or bearish, as long as it is a doji or spinning top. And then this candlestick must be bigger than this one. Not a must, but when it is bigger than the bullish candle, it means that the trend is the trade is a high probability trade. So when this one is bigger, you start looking for sales with high probability. So you will enter aggressively, or you enter without fear. Okay, yeah. So this is the evening star. So look to sell here. So how do you sell? You wait for this candlestick to close. You enter here and put your stop loss above here. Then you target 1 to 2 or 1 to 3, or you target in form of pips, which I think we'll do later. Yeah, so this is the evening star. So guys, as you can see here, this market was bullish. It was making higher highs and higher lows. Like it was going up. Okay, so when the market came and reached somewhere here, it forms that evening star. You see this candlestick, and you see this is like an inverted hammer, and this candlestick is bigger than the first one. So after that, you wait for this three candlestick to close, you wait for the third candlestick to close. When it closes, you close here. When it closes there, you enter your sales here, and you put your stop loss above that high. Then you target the previous low, so you will target here with your sales. So if you entered sales here, you see at the end of the day you get profits, because you will be taken out here in profits. Yeah, so that's how the evening star works. Even here, you see, this is the evening star, and you see how the drop was. Yeah, very crazy, very crazy.
Okay, so the next pattern we'll have engulfing bars. And in the engulfing bars, we have two types: the bullish engulfing bar and the bearish engulfing bar. But this one is a bullish engulfing bar. So what is a bullish engulfing bar? So these are one of the most aggressive reversal signal. They show up at the turning points. They tell that the previous move is done and the market is ready for a reversal. So these ones will appear after a strong bullish move. And when these ones appear, you will know that now the market is ready to start dumping. This is the bearish bar, and this is it happens especially above a liquidity sweep, above a resistance, or inside a supply demand, a supply zone. Because like when the market was dropping hard, and then it reaches on your demand or on your support or after a liquidity sweep, and then it forms this pattern, it is like telling you that the market is now ready to buy. So you start looking for buys instead of sells. So you should not don't worry, because we will do this now. Let's do these patterns on the chart and see how they move and see how they act. Okay,
The other patterns we'll do them, like the engulfing and some other ones that we have not talked about in this video. We'll do them when we are doing market structure, which I think will be our next lesson. So I hope you understand everything that we've learned today, and get ready for the next lesson.